I'd like to finish chapter 11 and talk a little bit about some formulas and how you quantify valuation for bonds. So let's dig right into it. What is an investing strategy? I mean, if you really think about bonds, what you should do is first determine what you think about interest rates, because how interest rates go is going to determine what type of bond investment you might want to invest in. So if you think interest rates are going to go up, you should buy shorter term bonds. They're going to be less likely impacted by that increase in interest rates. If you think they're going to decrease, then you should buy longer term but non-callable bonds, so that you don't lose your ultimately you don't lose your investment if interest rates decline too far. So let's talk about this in general. The pricing of bonds is really a time value question, right? What is the value of the interest income that you will receive over this time frame? And what is the value, in today's terms, of this bond's par value at maturity? So what are those two things? So bond prices, as we talked about, are driven by market yields, right? What is the return that the market is paying to investors of bonds? That is the yield that we should consider when you're thinking about things like the term required return. What is the required rate of return that investors want for a bond? That is exactly the interest rate that bonds are paying. So the market yield ultimately becomes the discount rate, because the market yield is two things. It is the required return that investors pay, and since that's what investors want, that's what companies are paying. So that ultimately becomes the discount rate that we need. So essentially, how would we figure this out? If the average rate of return on a AAA rated bond is 3%, then that's the discount rate you should use for any AAA rated bond that you can think of. If they have similar risks, since they're all AAA, then they all should have similar rates of return. So if we look at this bond valuation chapter, and again, there are videos that you can watch that can that illustrate how you calculate this, how you use the spreadsheet. But you input the data. There's $1,000 is the par value. You're told this is a 20-year bond, goes under time to maturity. 9.5% is the coupon. That's what's paid out. And in this particular instance, this is paid annually, so this is a 1. If the market interest rate's 10%, that's the required rate of return, this bond is worth $957.43. So that is the most you'd be willing to pay for this bond. So if you could buy this bond for $900, would you pay $900 for something that you thought was worth $957? Of course you would. So now let's look at what happens when we think about returns, right? We know that the market price is stated to us. We know what we have to pay for things. How does that impact the returns that we might receive if you're thinking about investing in a particular bond? So there are 4 measurements of yields, right? The first measure is called current yield. It is the annual interest income divided by the current market price of the bond. So it's the coupon, how much you receive that year, divided by the current market price. It only looks at current income. Now it will turn out that this might be a substantial piece, but it's an annual look, not a time value look. Because of course you're going to get this annual interest rate over and over and over again over the life of the bond to maturity. So its usefulness in understanding value is really not as important as some of the other measures that we can discuss. The yield to maturity is the most important measurement that we can have. It is true yield. It's the actual return you'll receive if this bond is held to maturity. Now, it has some corporate finance context to it, right? It assumes that all interest income is going to be reinvested at this market interest rate, and we assume that we know that interest rates change over time, so it assumes that there's no reinvestment risk. We know that's not true, but it's a very good value or very good understanding of what's going to happen if we get the exact cash flows that we expect. What is the return on our money? So without a calculator, though, it is a fairly complicated formula to determine the value. So so what do? We have the market price of bond 1,000. Again, here we have the same bond, right? $957 is the value, and let's say this bond is selling for $935. So in this spreadsheet, you input price under 935, and the returns start to calculate themselves. Over the first year, you actually receive 10.16% in the first year. But the yield to maturity says that on average per year, you're going to earn 10.28% on average per year over the life of this bond if you hold it till maturity. Now, what are you going to do with the the $950 coupons that you get? Of course, they're going to be reinvested. But that is another question. That isn't the thing that we're interested in when we think about this yield to maturity question. Yield to call. It's very similar. It assumes, though, that a bond is going to be called on the very first call date that it can be called. It uses what's referred to as the call price or premium instead of the par value, right? So again, this is considered to be the true yield that's received if the bond is held to this call date. So let's look at the information. The call premium is the par value plus 1 year's interest, and the call is deferred for another 5 years. So down below here, we have two boxes that you can input data. The call premium is $1,095. It's 1 year's interest, $95 plus the 1,000, and we say that this call can happen in 5 years. So the yield to call is 12.81%. So let's put this into context. If you hold this bond for 20 years, you're roughly going to get 10.28% on average. If the company calls in 5 years, you can earn 12.81%. So the question remains, what is the likelihood that interest rates in the economy are going to fall far enough so this company will be inspired to call their debt? Because if they call, you're going to earn 2.6% on average more than you are in the yield to maturity category. So if you think that this bond is callable, that actually the likelihood of callable is true, then this is a good investment. You're going to get more if they hold it, if they call in 5 years, than if you hold it for 20 years. Expected return is another kind of a question that talks about investors who trade in and out of bonds, right? In other words, we can say this person wants to invest in bonds, but they only want to invest for the next 5 years. So we need to understand, if you're only going to hold it for 5 years, what rate of return do you think you will get? The big question here is, what is interest rates going to be? Excuse me, what are interest rates going to be when we get to that sale date? That's the hard question. We need to forecast interest rates. So in this example, right, we're going to hold this bond for 10 years. And at the end of that 10 years, we expect the price of this bond to fall to 8%. So what will be the value of this bond in 10 years? Well, this now is a two-step question. The first thing we need to do is forecast what will be the selling price in 10 years if interest rates go to 8%. So in 10 years, right, we now have 20 years left on this bond. So in 10 years, there'll be 10 years left. And the required return will change to that new market rate or forecasted rate of 8%. So in 10 years, this bond will be worth $1,100.65. So now I can use that future price to determine what I would get if I would buy the bond today and hold it for this time frame. So now let's look. There is a place to input this data. The expected price, $1,165. It's going to be 10 years when I sell this. What's the realized yield to maturity? 11.21%. Now what you can see is that all three of these yields are all greater than the required return. So this bond, no matter what happens, this bond is a good investment. My hope is that I have a forecast of interest rates that's going to drop substantially so that in 5 years the call will be the option that will actually happen. Now I have to just use some forecasting tools or information to figure out exactly how much I think interest rates are going to fall in the future. One of the tools that we can use to help us understand how interest rates and bond prices react with each other is called duration. It's a measure of volatility. It measures how bond prices change when interest rates change. So it's a little bit of a better tool, if you will, than yield to market, because it also considers the importance of reinvestment risk. So it compares the sensitivity of bonds to changes in interest rates. So it's looking at what's going to happen to future investments or reinvestment of these interest payments. So the bond duration, as definition, is the average amount of time it takes to receive the interest and the principal once you purchase a bond. It's based on weighted average cash flows that are discounted at the required return of the current yield to maturity on this particular bond. Now that's a really deep subject, and in a more advanced investment course, we would go into this in a little bit more detail. But essentially, this is what we need to know. Bond duration has these properties. Bonds that have higher coupon rates have shorter durations. So higher coupon rate bonds are less sensitive to price changes than lower coupon bonds. Longer maturities have longer durations. They are more sensitive. Higher yield to maturities lead to shorter durations. So bonds that have high investment opportunity right now as far as returns will have shorter durations than lower yield to maturity calculations or bonds. So duration is a better indicator of bond maturity and its impact on prices. So if interest rates are going up, you want to hold bonds with short durations. When interest rates go up, bond prices go down, but shorter duration bonds are going to go down less. And of course, vice versa is true if you think that interest rates are going to go down. If interest rates are going to go down, you know that bond prices are going to go up. You want bonds with long durations so that the increase in price is magnified, if you will, by this sensitivity. So how do you measure duration? It is a terrible, hard calculation. But essentially, we have this number. There's something called Macauley's duration. This is the pure number. 9.67 is what's referred to as Macauley's duration. Modified duration is the number that we use to calculate the price change. So it is just a calculation. It's an adjustment of this other duration number, just to adjust it to, in the end, it's not an exact measurement because of a curvilinear nature of bond prices relative to interest rates. But again, that's another story for another day. So if you have a bond here, this particular bond that we've been talking about, and if it has changes interest rate, if it goes up by 0.13%, right? It's like essentially just 0.13%, then the change in value is going to be negative 1.1%, right? So an increase of 0.13, we know if it's going up, we know bond prices are going down. So the new price of this bond is going to go from 935 to 924.75. It's going to decrease by 1.1%. So that makes sense. What would happen if interest rates dropped by 0.13%? Well, then the change in value would be a positive 1.1%. And then we have to multiply that to figure out what the new price would be at that level. How investors use duration then is through a process called immunization. And immunization is the process of trying to control and understand these movements in interest rates and bond prices. So when interest rates change, let's think about what happens to bonds when interest rates change. We have already talked about that when interest rates go up, bond prices go down. And we know that that's a bad thing today. However, when interest rates go up, coupons that you receive in the future are going to earn a higher rate of return. So even though interest rates went up today and bond prices are down, there is a positive reinvestment risk effect that comes from interest rates. So every time interest rates change, two things happen. There's a price effect and there's a reinvestment effect. And they are opposite in sign. Not magnitude, they're opposite in sign. So what we would like to do is, the term is bond immunization, is we want to match the duration of our portfolio to the investment time horizon that we are investing in. So if we want to invest, in fact, we're talking about here, that last example, we're going to invest for 10 years, right? Well, if we're going to invest for 10 years, then we need to have a bond portfolio that has a duration equal to 10. Now, at the end of the year, what's going to happen? Well, now there's only 9 years to maturity, to the end of our investment horizon. So we're going to have to manage this portfolio so that as time goes down, we will adjust the duration of our portfolio so that every year, in year 9, there'll be 9 years, the duration will be equal to 9, then 8, then 7, etc. And if we would do this, we would offset the positive negative impact of these two changes. So in net, by immunizing, you eliminate interest risk in our investing of bonds. You negate the plus and minus impacts. What are the basic strategies that you can talk about? Well, you can either be conservative with bond investments or you can be aggressive, right? If you're aggressive, you're really going to look at capital gains. Now, this is not the way that most people invest in bonds, right? So for short holding periods, you're going to trade a lot. Your forecasted interest rate strategy is going to be the most important impact or part of this strategy. It's very aggressive. It's going to be more expensive because you trade more frequently. A conservative approach is more of a buy and hold kind of a strategy. You focus on current income. So you're looking for high quality bonds that have longer holding periods. And through this, obviously, you're focusing on cash rather than capital gains. So we have a bond and hold strategy, right? You replace bonds as they mature or quality declines. That's how you make your changes in your portfolio. There's something called a bond ladder strategy, where essentially you're going to invest equal amounts into varying maturity dates, like 3, 5, 7, and 10 years. So as bond matures, right, as these 3-year bonds mature, you would then replace them with new 10-year bonds. So you would continually replace bonds that mature with longer terming bonds at the end of this ladder that is your investment horizon. This is going to provide potentially higher yields with longer term bonds. And you get a dollar cost averaging benefit that's going to help you spread out some of the costs of investing in bonds. There are also things referred to as swaps. There are two particular swaps that I think are usually the most popular, if you will. One is called a yield pickup. So you're going to sell a lower yielding bond and replace it with a comparable credit bond that has a higher yield. I mean, who wouldn't want to do that? You have similar risks and you just switch to a higher return. Again, you might be able to do this between bond sectors, right? And the industrial bonds are a little bit lower yields now than utility bonds. So you move out of industrial, you move into utility bonds. But there also is the potential of something called a tax swap. You sell a bond that's declined in value. You have a capital loss. And you're going to buy another bond of comparable credit. So essentially, you're going to take this capital loss and you're going to be able to utilize that to offset some of your current investment income. Now, one of the things we have to watch out here for is we have to watch out for something called a wash sale. This new bond that you buy can't be an identical issue of the old bond. So you can't get rid of a capital loss by buying the capital loss asset. So it has to be another bond, maybe another company, maybe another industry, but it has to also then have comparable credit quality. In this case, you ultimately would get to utilize this capital loss for your bond strategy. So that's the end of the chapter. Hopefully that was useful. Don't forget to watch the videos that talk about how you calculate returns, duration, etc.